My name is Jim Mitchell. Today we're going to talk about whole life insurance. We've done a series of these. One of them we talked about term insurance. Then we talked about universal life. Now we're going to be talking about whole life. In the last one, we talked about universal life. We talked about the importance of having a permanent insurance policy when you retire. There are two types of permanent insurance. One is universal life. The other one is whole life. Universal life is basically you're buying term insurance and putting the difference into a side fund to either help pay premiums later or to accumulate and build values for possible retirement income. Whole life works similar, but it's not quite the same. Whole life is based on the entire life expectancy of the individual. So let me give you an example here. Okay? When you look at term insurance, and I mentioned that term insurance is you can buy term insurance for 10, 15, 30, and for lifetime. Well, you know what? One of the best lifetime insurance policies is a whole life. The premium is guaranteed for life, and in reality, all it is the average of the term insurance premiums over your lifetime. Okay? Not quite that simple, but pretty close. So when they calculate what a whole life premium is, it's based on if it's 100 or 200,000 of whole life or 500 or $1 million. They're saying that to provide that insurance, it's the average of what the term insurance rates were over the life of that individual. Now, the differences are that basically if it's an average, then they're charging more when you're younger and less when you're older. Okay? So it works something like this, and that's where the term cash values came into play in whole life. Usually in the first 3 years in a whole life policy, and this represents 3 years, there's not any value in the whole life. That basically, if you surrender, it's not a good idea. If you surrender a whole life in the first 3 years, whatever you pay, you'll never see a dime of it. But interestingly enough, after a 3-year period, what happens is as you pay premiums, the cash value increases almost equal to what you pay in that 4th year, and in the 5th year and thereafter is usually equal to any premiums you pay. So the example would be if I had a $100,000 whole life policy and my premium was $100 a month for that $100,000 whole life policy, I'll have that $100,000 for my entire lifetime. That $100 a month, if I surrendered that in that first 3 years, that's $3,600 I could stand to lose. Now, most insurance policies have surrender penalties. Universal Life also has surrender penalties, but they also have policies that have no surrender fees. So be sure to talk to your financial and insurance advisor regarding what's best for you if you want to look at a permanent insurance policy to take care of needs from age 60 on, or actually age 55 on. Okay? Now, the advantage here is that in year 4, I'm going to pay $1,200, and the cash value in my insurance account is going to increase by that. And every year, as you'll see here, as I pay my premium, my cash value is going to increase. So in 10 years, if people come to us and they say, well, what's this costing me? Well, I'm saying, you're putting out $100 a month, your cash value is increasing $100 a month, and you're getting 3 or 4% or 5% return depending upon what company you're with. Okay? So it's not a bad place to be putting money now. A few years ago, that didn't look too high. But right now, 4 or 5% is a pretty good deal for most people. Okay, so you have $100,000. That's the death benefit. So over here, you can see initially that this represents that death benefit. And you'll see the cash value continues to increase, and it will mature at your life expectancy, which is roughly 100 to 120 years under the new life expectancy tables. So if this was, your age now was 30, and this was age 100, it would mature, in 70 years, it would mature for the full amount. The cash values would equal the face amount of the insurance. That's a permanent whole life policy. Okay? Now, in addition to that, it's going to pay dividends. Those dividends are added to the death benefit. And so in this case, over that long a period of time, gosh, the dividends would probably be over $100,000 also, probably 2 or 3 times that. But you can check by having an illustration done by an insurance agent or advisor, and they'll help you determine and make comparisons. Look at universal life. Look at whole life. Find the need for which you want the insurance and need it for post-retirement reasons, and then determine the kind of account you want to do that's going to be permanent. Anyway, in this case, you'd have a $200,000 or more death benefit, and because the dividends would be paid on top of the face amount of the insurance. So, whole life insurance is designed to be there for your whole life. It is designed that as long as you pay your premium, it will never lapse. When you pay your premium after the 4th year, you basically have no cost for the insurance. Okay? Now, does that mean it's a good investment? No. Life insurance is not designed to be an investment. There are benefits that occur that look like and will possibly even outperform some investments, but not when you just buy the life insurance by itself. Anyway, this will give you a better idea of what whole life insurance will do for you. We just ask that you kind of look this over and give it some thought as to the types that you want. Thank you very much, and have a great day.